Traders, Matt Chapman here, the creator of the trademark Trap Traders concepts. Welcome to today's Trap Traders Trade of the Day analysis. Today's date's a sunny Friday, the 1st of September, 2017, and I'm going to take a look at the Euro Yen on a 30-minute chart. Obviously, we've got NFP today being the first Friday of the new month, so obviously you just want to wait until the end of that result to then look to probably take some type of dollar-related trade, obviously. But I just wanted to highlight this particular chart, kind of interesting. Whenever you're in a trending environment, what you want to do is you want to, if you know that you can see for sure that you're in a trending environment, what you want to do is you want to look for counter moves to that trend, and look for people being trapped and stopped out along the way. So, well, how do we know where people are being stopped out? Well, if you were, let's just take this move up in isolation. If you were looking at that trade, you'd missed the initial trade, but you wanted to take a trade on a retracement. Well, this is the first place and the only place where you could have gone. You could have gone long on that pullback. So you go long on that pullback as price starts going up, and the only logical place really to stick your stop under that condition is really under the swing itself. Now, obviously, you can make an argument that people are going to lower swings. That indeed will be the case, but there'll be fewer of them in number. Most people cluster around the swing point. So what you can see here then, as a result of that, is that you get moments where those people get stopped out, right? And there's that adverse price action counter to the trend. They get stopped out, and then it fuels the move up. How does it fuel the move up? Well, if you're a buyer in a trend over here in this retracement, your stop loss equals sell orders, right? Sell contracts in here. It's always opposite to what you do in terms of your trade entry, i.e. if you buy, to exit that position you must sell. If you sell, to exit that position you must buy, irrespective of how that goes down, whether you get stopped out by the order itself, by a stop loss order, or whether or not you get stopped out so you exit manually or you take profit. It's always the same equation. Now, if you are indeed in a trend, then obviously it's not going to go in straight lines forever. It's going to have to ultimately sucker people in the wrong way to some degree before it follows through. And the reason for that is, if an institution's long, they want to be buying and buying and buying, and the really big institutions can take months to essentially build into a position, and likewise months to unwind the position. So when you get a trend emerge, they don't happen that often, but when they do happen, they're obviously monster trades. But everybody can't be buying, so along that route, people must be convinced to do the counter of the trend. What that does is that fuels the big guns' ability to execute efficiently in the direction of that trend, meaning you'll get stop hunts, right? So there's a stop hunt, and that allows something big to do some buying in the face of that forced, what I refer to as forced selling. And again, you've got situations that the market continues higher. You've really only got these swing points beyond having a stop way down here. Again, they get creamed, right? So something was able to do some buying there, and then you've had some selling since then, and a bit of accumulation in here. So if this pops up, because these people are selling, in my opinion, against that monster trend, if this pops up, you probably want to be a buyer, because it wouldn't be a shock to see that break to new highs. Or if you want to wait until it does go beyond that, then obviously that's the play. But what I just wanted to articulate was a trend is obviously not does not move in straight lines. What it has to do along the way is it has to convince people that are taking trades counter to that dominant trend, in this case the uptrend, and then it sucks them in and refuels to go higher, and then it does it again. And that's why Fibonacci retracements, as an example, as an idea in and of itself, is kind of flawed, because what it's doing really in many ways is it's setting you up to become cannon fodder for the institutions as they suck up those orders to allow them to transact in these efficient zones. And these efficient zones, as I say, are where liquidity is residing in the direction of the trend. They want to be in the trend too, but their position size is so big they can't just buy with everybody else. And if obviously there's not enough liquidity on the other side, it's not going to work. They're going to get bad pricing, slippage, etc. And that's just not acceptable. So they will look for these efficiency zones, if you like, where these stops reside. It's not hard to see. I can teach you exactly how to do this, and if you'd like to learn how to do that, so ultimately you're always making sure you are trading in the direction with the big institutions, then click on the link below, and I'll see you on the inside. Take care.